Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Catriona, welcome back to the Australian Investors Podcast.
Thanks for having me.
It's always good to chat, and particularly after a few logistical challenges on my end. I do appreciate you sticking by and sharing some thoughts with us while you're back in the country. Because for folks that don't know and folks that aren't familiar, you manage the WAM Global strategy, and you're based in New York, correct?
Correct.
Yes. So how often do you get back to Oz?
At least a couple of times a year, usually.
Yeah.
I was back about a month ago for our roadshows around the country, and now just back again.
Yeah. It's interesting because, obviously you're a global investor, you're investing right around the world. There's a, significant proportion of the portfolio in the United States, which we might get to in a minute. But I thought it's obviously been a tumultuous few years, as we're just talking about off air, like with COVID and what have you. But it's obviously an advantage being able to see consumers on the ground, being able to see businesses in real life and actually experiencing what their consumers are seeing, chatting to people, management, that sort of a thing. But we're going to spend a bit of time talking about the way you invest, but also some of the companies that have come out of the recent reporting season. So I would like to just kind of pick your brain. And it's been over a year since we spoke. And I'm curious to know, maybe over the past 12 months, if you just want to have a bit of recency bias here, over the past 12 months, a company or companies that may have surprised you on the upside, and maybe companies that have surprised you on the downside. I know that's a pretty broad question, but I'm just interested to see, kind of, as you reflect over the past year, what's caught you off guard.
Sure. A company that's kind of has been a positive surprise example, and one that we hold in the portfolio, so that's probably delivered even better than we thought, is one called Quanta Services. So they do upgrade and maintenance work for the electrical and transmission grid across the US, across communications infrastructure. And this was a business that, we've known for over 15 years, didn't have an investment, but then through COVID, we're looking for businesses that were still able to operate and function properly through the COVID period, where we thought they had earnings certainty because they were still operating fine. And what better area than the grid, because the electricity demand and so forth, as we're doing this call over Zoom now, what was needed was people were moving to the cloud. They needed to still be, able to communicate, and the grid in the US needed to be the teams for Quanta needed to be able to maintain and upgrade the grid, even despite the world being in total chaos through COVID. So having known the business, known the management team, bought a position, thought there was, great earnings certainty and upside to expectations. But what's really positively surprised us in the last 12 months is just the incredible momentum that AI is causing for this business. So, we've all seen from the recent tech company results how much investment is going into CapEx spend for how many data centers are being installed and built. And this is just causing enormous demands on power that we haven't seen in decades. And so this business, the Quanta, which does all the upgrade and maintenance work for the grid, has been an enormous beneficiary of that. And so what we've seen and what we see for, years ahead is just enormous demand for their services. And the utilities across the US, dating back to the GFC and even before that, started outsourcing doing this maintenance and upgrade work to players like Quanta. And so they are the biggest in the US at what they do, an outstanding management team that are really executing well. And so it's a great example of where we had a thesis around, the sustainability of the earnings for this business and their ability to continue operating even in what was a completely tumultuous COVID period. But what surprised to the upside and continues to surprise is just that incremental power demand that is being, and that, that pressure that's being placed on the grid from AI, but also from reshoring. So all the manufacturing and production that's coming back onto US shores is obviously means that there's more power demand. You've got electric vehicles, you've got energy transition. All these things are putting increasing demands on the electricity and transmission grid across the US and across, the communications infrastructure, which has just been an enormous benefit for Quanta. So that would be an example of a stock that's surprised us on the positive side. I mean, one we don't own that's been negative, had negative surprises is probably is Apple. So, they've been caught out in terms of their execution around AI and exposure there. They've seen earnings growth really slow, as you've seen. You had through that COVID period enormous demand for goods. Whether it was we all needed to upgrade laptops, whether it was people were at home and they were updating their couches and pillows, and then you saw as the world reopened that demand move from goods to services. And I think Apple's been caught up in that, and so. It isn't a stock we've owned, but it is one that I think has disappointed in terms of the earnings growth, particularly when you compare it to some of the other tech companies that are massively benefiting from, that move to the cloud, that move to realize that, okay, to get on the cloud, you need to implement AI, you need to be on the cloud. And so the demand for, whether it's AWS, whether it's the Google Cloud or Azure, they've seen enormous amount, and Apple's sort of been left behind.
That's fascinating. I do remember tuning into the Apple call recently and thinking, and there was so much, there was pessimism built in the result, and they probably delivered slightly above, but they were still negative, and that really kind of caught me off guard in terms of not necessarily the result, but just more so the kind of momentum shift behind the business and how they're cycling out of COVID was really interesting. Last time we caught up, we spoke a lot about your process and how you think about constructing portfolios and that type of a thing. But one of the things that you do is you invest globally. It's a listed investment company. But you're targeting high quality companies that have become dislocated from basically valuation. So you're targeting those opportunities, but there needs to be a catalyst as well. And for those folks who aren't familiar with what you mean by a catalyst, what would that look like? Like, how does that take shape in practice?
Sure. So when we're talking about catalyst, it can come in many forms. It might be that we think so we have where our process has multi-layered in terms of what we're looking for, and it starts with industry position and looking at a company and assessing what is their industry position. Are they gaining share? Is the industry structurally going from fragmented to less fragmented? And assessing that, we assess the management team of the businesses we look at how high quality are they, how are they delivering on forecasts that they've set, and ability to execute over time, the earnings growth potential of the business and the sustainability of that earnings growth, valuation. And coupling that earnings growth with a reasonable valuation, and then, as you say, that catalyst piece. So, what do we think? What do we see that is perhaps a differentiated view to the market? Is there earnings? Do we think earnings are going to be stronger than the market is forecasting? So we see earnings beat potential. Is there potential M&A that we think is being, not being recognised, and there's a massive opportunity there in terms of extracting synergies, etc. Is there divestments? Is there a new management team in place that we think, we have seen them deliver their track record at a previous organisation, and they've joined this company that we, are interested in investing in. So we're looking for something that's going to change the valuation and, re-rate the share price. Because, you can have cheap stocks that are cheap for a very, very long time without a catalyst to, drive value creation. And so we think adding that catalyst overlay is what drives the share price to re-rate to its potential, and to a valuation that more, aptly reflects the quality of the business. So from a stock, and a stock that we talked about last time, CTS Eventum, for example, would be a great example of that, where again, there was a massive. So basically, they are the Ticketek equivalent of Europe. So they have very high market share. Over 80% market share in Germany, over 60% in Austria, Italy, and Switzerland. For us, we knew the company, founder-led, net cash balance sheet. Clearly from that industry structure piece, ticked the boxes. Management, very high quality, aligned with us. Earnings growth potential, significant. But what for us interested when we so we'd had an investment, we'd sold it, and then we looked at it again in COVID, because ticketing, no one was going to any concerts during COVID. The whole business was under pressure. They were stripping out costs, didn't know when the world was going to reopen. But the valuation to us, if you assumed that the world would recover and we would start going to concerts and ticket and events again, the business to us looked ridiculously cheap. So we thought that the market and the analysts had brought down their forecasts for what the earnings potential would be. And so for us, the catalyst there was we saw massive earnings beat potential as the world reopened. And we saw, they've bought a business in France, which is the leading ticketing player there. So catalyst as they unlock the synergies from being the leading player in France. So, this has been a multi-catalyst story in terms of they've had various earnings beats, and because earnings have come back very strongly out the other side of COVID. You've got artists make all their money from touring. And so you typically see artists go through the US and then to Europe. And that's what you're seeing now, where lots of American artists, for example, have gone on tour through the US and are now moving into Europe. They've stripped out costs through the COVID period so that margins as revenues come back look even better than they did before, which it's very hard to imagine, when you say you've had a business with a certain cost structure and you think the margins historically were 20%, but they've taken out X dollars of costs, actually the margins in future can be 30%, et cetera. So you're imagining a world that hasn't existed before because the cost structure is fundamentally different to what it was before. And say in the US, when I go to a concert or whatever, you now do everything with your mobile wallet. You carry your tickets on your phone, etc. That's been very slow to roll out in Europe, but that is rolling out now. So the margin structure is even better than history. Again, because of the cost structure, and two, because they take a bigger take rate on the mobile tickets. So they make higher margins on mobile tickets. So again, you're imagining a world that didn't exist before. So analysts are very reluctant to put that into numbers because they haven't seen it delivered on. This was a very catalyst and is a very catalyst-rich story for us because they keep beating and the analysts are kind of behind the curve, which is a great. And that's, that when you see earnings reporting season and you can have, you have an example where a stock beats, but the stock share price does nothing. It's because everyone, fundamentally the numbers might have been too low, but it wasn't enough. Like consensus with buy side was already expecting that. And for us, this has been really interesting because they've continued to meet and beat expectations, and it's both the buy and sell side have been sort of catching up to that. So a great example of a catalyst-rich story that's continued to play out over time.
So this is the business CVS Eventum, is that right?
CTS Eventum,
CTS. Yeah, I remember.
The code is EVD.
EVD, that's
Germany.
why I was confused. Yeah. Remember when we first spoke about this, I thought it was a fascinating business, and I went and checked it yesterday in anticipation for today's meeting, and it has performed really, really well as the world has reopened. And it's good to see the thesis playing out, that's what we all want as investors. One of the things I wanted to talk to you about was basically what else we've seen in US reporting season. Obviously, you mentioned Apple there before, but a lot of companies have been reporting some results thick and fast. I'm wondering if there's been, it's pretty easy for me to say winners and losers, which we can get to in a second, but just as a broad overview, what you've seen so far.
Sure. So, as the headlines would tell you in terms of the biggest news flow has been around really that AI massive big tech capex spend, and a lot of that going into infrastructure, data centers, investing ahead of AI, etc. So that's been a massive thematic that's got a lot of news flow. The other area is a lot of debate on the consumer and very mixed signals in terms of the health of the consumer. So that's another kind of thematic that's come out of reporting season. And then on the, I'd say in the healthcare spend, we've seen steady resilience in healthcare spend. Biotech funding had been massive and then had come off and seems to have stabilized. So we're seeing some stabilization there and strong trends in terms of, say, the hospitals operators in the US still seeing very solid demand. Cyclicals have been very interesting because we look at a lot of these cyclical, more cyclical industrial businesses, and a lot of them were not pricing in, the operating environment getting tougher at all. And so the valuations looked very high and they haven't been able to meet expectations. So some of the more cyclical businesses, say in transport, et cetera, have disappointed. And then China's been another spot that's been called out as weak by a number of businesses, whether that's in medical equipment, whether that's Starbucks, for example, calling out China specifically, Estee Lauder calling out China as an issue. That would be another area that's kind of specifically being called out as an issue. Europe, again, is very much about picking your spots. So, say businesses like CTS doing very well, like that goods versus services dynamic where services have been a lot stronger than goods continues. And you've seen that, even fascinatingly, even in the travel space, you've seen companies like Norwegian Cruise Lines, like Delta Airlines saying the operating environment is incredibly strong, whereas you've got the apparel companies complaining that it's tough. Yeah. So lots of divergence. Overall, still China weak spot, US generally resilient, but when you look at the consumer at that next level down, some discrepancies.
It's interesting. I'm headed over to Europe in about 10 days. And things aren't always cheap on the travel front, I can tell you that much. And things do look pretty busy. So we'll see how we go in a few weeks. When you think about like that consumer and the differences, how do you assess that? Like as an investor, like what are you looking for?
We look, there's both the economic data releases, whether that's retail sales, consumer confidence, savings rates. So there's the economic data front that you're kind of looking and assessing those factors. And then there's the company specific, earnings calls, listening to, there's nothing better than hearing it from the management teams of the companies that you're looking at. And it is really interesting. You've got that say in that travel, but some of them are saying I've never seen a better operating environment, like pricing as you're finding out from when you're booking European travel, extremely good right now. But then on the other hand, you've got, say, Estee Lauder, which has big China exposure, saying, think we have no visibility right now. It's tough to predict where profits will go. And then on the other hand, you've got, say, Nike and Lululemon, et cetera, where the competition's been very strong and where they had inventory problems, saying it's kind of tough. So and even say McDonald's, for example, or Starbucks, saying Starbucks has called out China issues, McDonald's has called out issues in the low-end consumer. So it's basically, that mosaic of information that you're collecting to kind of form a view on, where the consumer is at. You're looking, even at savings rates, for example, you've had the reason the economies have been able to be very resilient, say in the US, for example, like it's multifaceted, where you've had enormous COVID savings that took, a reasonable period of time to be kind of winding down, and they're nearly, used up now. And you've also had enormous government spend that's helped the economy.
For sure.
But on that pool of savings, excess savings, the longer the sticky inflation goes on, the more pressure the consumer comes under, and particularly at that low end where that savings levels are even lower than obviously at that higher end consumer.
I was looking through the portfolio through the I think it was the latest monthly update for the WAM funds, and I noticed a few really interesting names in there. But you just told me off air that you do not own McDonald's and Starbucks, but those are kind of two that you mentioned, and they're both like consumer type brands. And I was going to try and play a little game. I was going to ask you if you had to pick one which you thought had the stronger competitive advantage out of McDonald's and Starbucks. Obviously, the Australian experience with Starbucks, everyone would say McDonald's because Starbucks isn't much chop, at least not in Melbourne and Sydney, even anywhere really. Perth, everyone has good coffee these days. So if you had to pick one, based on like your experience, like in New York, all around the world investing, which one would you pick?
Yeah, good question. And I being, from Sydney and going to New York and living in New York now, it's remarkable how much the coffee, the coffee offering has improved, I would say, in say a place like New York. Like historically, it's been very hard to get a good, a great coffee, and it is much improved, I'm happy to say.
Okay, good to know.
But not to the detriment of Starbucks, because I would say it's amazing how many small, like the barriers to entry, obviously, to have mass rollouts with, uniformity and offering and blah, blah, blah is not so easy, but the ability to open up a great coffee shop on any street corner, there's significant numbers. So, I would say of the two, McDonald's would be, not the preference for personal consumption, but the preference in terms of, durability of competitive advantage. I'd probably say neither, though. And if I was looking for an investment, I would prefer something far less rolled out in terms of and penetrated in terms of the market. So whether it's Shake Shack or Chipotle or like a brand where it just isn't so far along the growth curve. So I'll give you McDonald's over Starbucks, but I'll give you neither, and pick alternatives as which just aren't so mature in terms of the story.
Well, those business models are wonderful because they're basically copy and paste, right? Like they're repeatable business models, and if you find the next one of those, it's wonderful. How about this then? I would notice that. Correct me if I'm wrong here, Catriona. I noticed that in the WAM Global portfolio, I think you have Visa and MasterCard. Am I correct in that?
Just Visa.
Just Visa. So why Visa and not Amex or MasterCard was going to be my question.
So all great businesses prefer Visa. If you had them all at the same valuation, I would prefer Visa and MasterCard over Amex just because they don't take the credit risk, whereas Amex take credit risk. But great network businesses. And for us, it's valuation on Visa versus MasterCard. We think that Visa's cheaper than MasterCard, but both wonderful businesses, very geared into consistent consumer spending. Great, like both they have geographic opportunities still, wonderful network effects, very hard to compete with the relationships they have with merchants all over the world. Strong barriers to entry. But for us, and Amex, look, we think Amex and we have owned Amex in the past, and it's been a great stock for us. And they've done an incredible job, Amex, actually, of targeting the younger consumer, and really, you see them at festivals across the US. They have partnerships. They have Resi. Like they've done a wonderful job actually, like for a business that was historically like, your dad might have an Amex card or a business card. Particularly across the US, they've done an incredible job of really getting a younger consumer. So I think it is a great business. But for us, in terms of the preference of the model, it's Visa or MasterCard. And for us, it's Visa, just on evaluation grounds.
It's funny that you say that, because for so long, obviously people know Amex from Warren Buffett, if they're familiar, big shareholder in the company. But for a lot of times, people were like, well, people aren't going to be using cards anymore, so why does it matter if they have an Amex or a insert blank thing and they just use Apple Pay or whatever? But it's clear to me, just in my circles that I roll in, that Amex is still very, very, very abundant, and people still have that brand association with it. So just in the interest of time, Catriona, I'd like to ask you two more questions. But I was told to ask you about your non-negotiable businesses. And this was really interesting. It kind of falls out of the back of Visa, which is kind of a non-negotiable for basically everyone in the world that has to pay with a card or even over any type of payment. What falls into this bucket for you? Like, what falls into a non-negotiable business? Like, or what in that bucket, in that category?
Yeah. So, I mean, for us, when we're talking about the it's like, okay, well, what spend is going to happen? Like, is almost inevitable, and will continue. So, say we've got a lot of companies in the healthcare space. There is no doubt post-COVID increased focus on health and well-being. Seems to be this ever-growing pool of money allocated to healthcare spend, and an aging populations when you look across so many, places around the world. So for us, the spend that is going into healthcare, is just a wonderful, structural trend to be invested in. And for us, when we're looking for businesses in that space, we love picks and shovels. So businesses that are, part of the gold rush, but we're not trying to pick which drug therapy, in particular will be the winner. It's like, okay, we own things like Thermo Fisher Scientific, Avantor, Icon. So these businesses produce, consumable products that are just, you put in a machine, and then you have to continuously buy the consumables to run, whether it's clinical diagnostics tests, etc. So, and they sell to every pharma company, whether they're large or small. They sell products into academia, into R&D labs. So we think that spend in health and wellbeing and healthcare more generally is increasing and non-negotiable. It's just going to continue. And interestingly, with AI, the drug development cycles and the pace of innovation is really increasing. So we think that's a wonderful thematic to be geared into. I mean, the other one, like there are various other areas like digital enterprise. Like we think businesses that are geared into that transition to the cloud, like to use AI, you have to be on the cloud. So that, investment in cloud transition and then use of AI is great, as a wonderful thematic to be benefiting from. And we've owned businesses that, say SAP, which is the German listed ERP company, duopoly, but far out competing their major competitor Oracle. Done a wonderful job. The reason we bought it, everyone thought it was boring ERP, and our view was no, they were transitioning the business to a subscription model. So it was it temporarily was bringing down the revenue and earnings growth potential of the business. But we thought there, in terms of that growth, it would accelerate over time. And they are just going to be a wonderful beneficiary of cloud transition and then AI, use of AI. So yeah, we think areas like digital enterprise, the move to electronic marketplaces, is and the investment in critical assets, and then innovative health, and these are great areas where we think they're if you're thinking of structural drivers and being invested in stocks that are well placed to benefit, we think that's a great place to be. because it's hard. Forecasting earnings is to the decimal point is going to be hard. But if you've got great, wonderful structural drivers that really underpin long-term earnings growth, that's a great place to be.
Yeah, I would agree. And I think the way that my next question, I think you've kind of answered it, which is just going to be around how much the macroeconomic environment plays into that. But because you've got the catalyst and you're investing in a high quality business, they're going to be resilient in the face of that, which is really fascinating. I love the idea of a non-negotiable business as well. I think a lot of people think about competitive advantage as kind of like this abstract thing, and you've got to go out and search for it. But just thinking about it in those terms is kind of like which businesses will always benefit from continuous spend, from annuity-like revenue. I love that example of the ERP provider like SAP. Everyone everywhere using it. Things like Oracle, these types of businesses are just unavoidable in this modern world. I'm keen to see where businesses like Quanta you brought up, just written down in my notes because I hadn't really thought about it in the way that you articulated it before. But there's a whole heap of companies and lots to learn from following along with the WAM team in particular, the monthlies and the quarterlies. I'll put a link in the show notes to all of that, Catriona. But I really do appreciate you taking some time out of your trip back to Oz and sitting down to join me for the show.
Thanks so much. Great to catch up again.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.